I'd like to combine the next couple of questions because you have answered a component to it already. The first question I have is that do you look at real estate as being separate from the actual business? Now, not when it's held by a separate hold co, but when, for instance, and marrying that with the next question, what happens when the operating business is in a structure or building that is unique to the operation of the business itself? And again, not being held by a separate hold co, but is part of the business. So in a situation like that, how do you evaluate the business and the premises?
Good question. So the value of real estate, land and buildings, is outside our scope. So in that case, then I seek and advise an appraiser, a real estate appraiser, and I have them write a report that on which we can rely. And there's good information in those reports. They write really good reports, I got to say. The AACI guys, they just good.
Yeah.
In the event that the business requires that particular real estate, then we consider that, well, in either case, we consider the real estate to be a redundant asset or a non-operating asset that doesn't generate cash flow, that is of value to the business, but it's separate than the cash flow of the business. So we call real estate, buildings, and land generally redundant assets.
I
And
don't
they
think
may or may not be required by the business to be owned by the business. So I'm thinking of your corner coffee shop or, even a manufacturing facility. They don't actually have to own the business. Once we did a metal manufacturing company and they didn't own the real estate. The real estate was held separately in a separate company that we didn't value.
which is probably the smart way to do it. I mean, you should
Mhm.
never, I always suggest to my clients that that's exactly what they do. They separate the real estate from the actual business. But I've also had situations, for instance, when somebody was selling like a dairy production facility, which is very specific to its use. And in that particular situation, the business did own the premises. And, it was looked at when the dairy plant was decommissioned as more of a, to borrow your term, it became a redundancy because there was absolutely no other use that the building could be put to in any type of cost-effective manner because you're dealing with very specific parameters and things that were necessitated by the very fact that it was a dairy production facility. It just, again, it goes back and forth. I don't think anyone, or generally speaking, a business is going to have their real estate attached to the actual business itself. That isn't, I think, a wise way to conduct your corporate strategy. But in the case where it is, it can become a little bit problematic. But you're right, the AACIs, and for the sake of our listeners, that means Accredited Appraiser Canadian Institute, they deal specifically with commercial and investment property. And they are well situated and very knowledgeable and have an incredible database